Good afternoon or good morning for those of you who are not on the East Coast, and welcome to our presentation today on the principles of long-term investing resilience. My name is John Ogle, and I serve as the Chief Investment Officer here at Atlas in our Albany, New York office. Like some of you, perhaps, I count myself as part of a dwindling group of people who can recall a time when most individual investors would need to wait for the newspaper to come out the day after a market closed to find out how their stocks or bonds or the market itself had done the day before. And over the course of my 35-year career in this field, I've witnessed just an incredible increase in the volume and in the pace of financial reporting from news outlets, as well as the information that people derive from the internet, to include a deluge of what is sometimes outright misinformation. Unfortunately, much of the financial news we're fed is driven by the interests of advertisers, and while interesting in the short-term context, this can often be far less relevant to the investor who has a properly allocated portfolio and anything longer than a very short-term investment horizon. More recently, over the last 15 years or so since the financial crisis, I've observed that many individual investors, as volatility has increased, have seen emotions becoming more and more heightened, which can steer them towards making injurious decisions about their money and their portfolios. Often we see investors becoming more conservative in times after markets have sold off, or becoming more aggressive when market valuations are high. But along with all of this has come a much greater understanding about the actual drivers or contributors towards investment success and return. Today, Doug Orton of MFS will take us through some of the data and research regarding long-term investing resilience, and hopefully provide some relief for or from the onslaught of the relatively short-term economic and financial news that often causes us distress. Doug is a Vice President at MFS Fund Distributors, a subsidiary of MFS Investment Management. Doug has been in the industry for what will be 30 years next year, and he joined MFS 15 years ago in 2007. Over the course of his career, he's served roles in sales and marketing, training, tax, as well as compliance. Doug earned his bachelor's degree from Colorado College in Colorado Springs and holds a Series 7, Series 24, and 63 licenses from FINRA, which is the Financial Industry Regulatory Authority. And he is a chartered retirement planning counselor, a designation he earned from the College for Financial Planning. At the end of this presentation, if you have questions, we encourage you to reach out to your Atlas Wealth Management advisor. So without further ado, Doug, please take it away.
Thanks, John, and thanks everybody for joining us today. What we're going to talk about today is ideas that you might want to consider to keep yourself on track when we go through periods of market volatility like we're going through right now. But one thing that I do want to stress is I'm going to be sharing, broad concepts that are appropriate for a lot of different people, but might not be appropriate for you as an individual. So what might be helpful is to think about what we're going through today as just the first step of thinking about volatility and your plan. And then the next step would be how you apply that to your individual circumstances. So with that said, what are the 10 things that we can focus on to keep ourselves on track? And the first thing to think about is that investing has gotten a little bit more complicated than it was really when I started in the business. I started in 1993, and back then a relatively simple portfolio could be expected over long periods of time to have a 7.5% return, as you can see in the chart here. Currently, to get the same expected return, you have to add in a lot more different asset classes, and it also increases one measure of risk, which is standard deviation. And throughout today, I'll try to make sure I don't slip into bad habits of talking about risk in the singular. One thing that we might do as investors is oversimplify investing. And so sometimes we'll talk about something as risky or less risky. And really, there are multiple aspects of risk to any investment. Volatility, how much the price moves up and down day to day, that's volatility. We can measure that by standard deviation. And that is one type of risk. But we also might want to think about inflation risk and some others. We'll talk about that a little bit as we go through today's session. So how often do we have down markets? You know, sometimes we start thinking about what will I do this year if the market goes down? If you take a look at this chart, the blue bars are what the U.S. equity market, in terms of large companies, did over the arbitrary period of January to December. And as you can see, roughly a third or a fourth of the time we have a down year when we think about just January to December. But if you look at the circles, what those represent are the biggest downturn during that year. So if we ignore this, oh, it's got to start on January, it's got to end in December, and just think about what was the worst period during each year, what you'll see is every year has a down period in it. So I think there's two things that we can learn from that. One, this is not an unusual occurrence. If I started to plan for the winter, I live in Boston, and I started to talk to my neighbors about what will I do if it gets cold or if it snows, everybody would think I'm an idiot, right? It's absolutely going to get cold. It's absolutely going to snow. Talking about if it snows doesn't make a whole lot of sense. Some years we're going to get more, some years we're going to get less, but it's absolutely going to happen. History suggests that we will have down years or down periods in each year. It's a natural phenomenon. The second thing I would take from those little circles is a little bit, I don't want to say more complicated, but if you see the point where we're probably going to start to get concerned. I don't know about you, but if we're in a year where, like in 17, where the biggest drawdown was down 3%, I don't know if I even notice things like that. I certainly don't start to get fearful, but when we start to get in that 15, 20% range, that's where I start to notice, and sometimes I get a little concerned. And what you can see on average, by the time we get to that point where we're a little bit concerned, we've already taken most of the loss in the average year. I can't tell you what, each year will bring, but I can say that when we start to get really concerned is, in general, when we're nearer the bottom. It's one of the things that makes timing the market incredibly difficult. Second thing to look at is that downturns tend to be shorter than the upswings. We call the downswing a bear market. We call the upswing a bull market. And on this chart, you can see that the red lines are the bears and the blue lines are the bulls. And you can see that the down markets on average are about a year long. And, we have about a 30% drawdown. The up years or up periods tend to last about 4 years, or that's the average duration, and it's closer to 130, 140% up. So it's not just that bull markets are a bigger return than bear markets are down. One thing that also makes it tricky to try to time these things is bear markets tend to be short. And so for these short drawdowns, there's not a whole lot we can do. But there's a couple of things I think we can learn from this chart. One is whether a downturn is a good or a bad thing for each of us as an individual will very much depend on where we are in our investment life cycle. For me, I'm 52 years old. Realistically, I'm probably at least 10 years away from retirement, and I'm making investments into the equity market regularly. Not that I'm a genius or anything. It's every 2 weeks I get paid. Every 2 weeks, money hits my 401k and therefore gets invested. So for me, since I am regularly adding new money to my investments, these downturns are actually good. They help me build wealth over the long term because I am buying investments on sale. Now, does that mean downturns are good for everybody? Absolutely not. My parents are in the exact opposite situation. They are regularly selling investments because they're well into their retirement years. So for them, the blue periods are good because they're selling investments as they're appreciating, and the red periods are bad. So whether volatility is your friend or foe will depend on your individual circumstances. It's one of the reasons why in the opener we said don't take anything that we say as advice. It is just something to start that thought process. Now, if you are thinking through the slide, we probably need to talk about this period right here, starting in about 1965 into the early 80s. As you can see, the market moved sideways for a relatively long period of time, which means for somebody like me who's investing regularly, this was actually a great period to build long-term wealth. It's why people who were in their peak earning years during this period and investing regularly built substantial assets. Now, if you're thinking, what happens if I'm a retiree in this period? It's a little bit different. And there's good and there's bad news around that, but we'll talk about that in a couple of slides. The good news, though, people were successfully retired during this period, and we might be able to learn some things from their experiences and what worked for them. If we look at the bond market, essentially the same story. The downturns shorter than the upturns, and the upturns are more expansive until you hit periods of volatility. Don't need to go through the same story again. Whether you're investing in buying companies, that's equity, or loaning companies or government's money, that's bonds or fixed income, the story is the same. If you're regularly buying, down prices are good. Regularly selling, down prices, not so great. So now we get into the part that is near and dear to my heart. John mentioned that I went to Colorado College, and you might think, being in this business, I studied finance or economics or something like that, would be completely wrong. I studied psychology. And that might seem like a weird fit for what we do in the financial services industry, but the way we think about money and the way we emotionally react to what's happening actually have a huge impact on our long-term success. We could probably turn this slide into its own half-hour seminar, but I'll try to restrain myself and go through just the highlights. There's a couple of things that we might want to keep in mind as we think about our investments. One is what we call familiarity bias. The more familiar we are with something, the less risky we think it is. Or conversely, things that happen more rarely, we overestimate the risk. Think about how many people are maybe afraid to fly, but not afraid to ride in a car, where statistically traveling the same distance, you are much more likely to be injured or killed in a long car ride than a flight. But we're not scared of driving, most of us, because we do it all the time. That's familiarity bias. Where this can impact our portfolio and our decisions can be things like our own employer's stock. When we go into major downturns, whether it was the financial crisis or when the internet bubble burst, we saw people who probably owned too much of their own company's stock. Now, before anybody asks, I can't tell you what an appropriate percentage of your own employer's stock is for you to own. That's going to vary based on your individual circumstances. But if you do own your own employer stock inside your 401k, I think that's a worthwhile question to ask your financial advisory team. Is this appropriate due to my, or does it match my long-term goals? And one thing that you're going to hear me say over and over again is our goals are what should drive our investment strategy. That's why different people will have different investment strategies, because we have different time horizons, we have different goals, we have different risk tolerances. We need those to match. The second one I want to talk about is anchoring. The day that I buy an investment, that day's not special. But in my mind, that price that I paid for it will become special, and I will anchor to it. So if I bought a stock at $100 a share, to me, that $100 a share now becomes important. So if it goes down, I might start thinking, maybe I'll sell it when it gets back to 100, or it's gone up and I'll pay attention to when it passes. The only thing to keep in mind there, the price that we initially paid doesn't impact whether an investment is meeting our long-term goals after we've bought it. The only criteria really is this appropriate for the goal that I invested it for? If not, maybe I don't want to have it. If so, great, I keep it. I don't want to anchor on arbitrary prices just because that's when I bought it. The last one I'll talk about here is oversimplification and hindsight actually go together. Looking back on what's happened in the market, things look obvious and predictable. For the people who have been investing in the market a long time, the bursting of the internet bubble in retrospect looks really obvious, and we should have all predicted it. And if you did predict it before it happened, great. Most of us didn't. We got caught by surprise. And the reason this can lead to bad decisions is if we think market inflection points, where a down market turned into an up or an up market turned down, were obvious, we start to think that we can predict when the next inflection point is, and by and large, we can't. That's enough about oversimplification and other behavioral biases. What does this mean to us as investors? What it leads to is emotional decisions can detract from our long-term returns. If we look at large U.S. stocks, the average return from 01 to 21 was 9.5 for that index. People who were invested in investments that invested in that index only got 8% return. You would think that these should be the same. One of the reasons it's lower is psychologically, we tend to sell something after it's fallen off in price, and we like to buy things as they're going up in price. And over time, as we sell things when they're cheap and we buy things when they're expensive, it is a drag on our returns. So I'll go back to our goals to drive our investment decisions, not our emotions. So when I'm looking at an investment and maybe it's gone down and I start thinking I should sell that, I might want to reflect on, have my long-term goals changed? Has the long-term prospect of this investment changed? If not, maybe I wait, let my emotions calm down a little bit and make a decision later. And the same basic things happened on the bond side of the investment world. It's just a little bit worse because for mathematical reasons, it's just harder to recover from selling something when it's down, when its expected future return is lower. Don't ask me to justify my math. As I said, I was a psychology major. We start talking about calculus or how to calculate that stuff, I'm going to be a little lost. So I said that your time horizon is an important part of your investment strategy, and here's why. Over shorter periods of time, we're more likely to have a downturn. If we talk about the equity market, in the average 1 year period, we've got about 1 out of 4 periods are down. So I can expect, if I'm buying US large company stocks, about 1 out of 4 years is going to be down. So if I've got money that I need to use a year from now, let's say my son's college tuition is going to be due a year from now, putting that into the equity market might not be a good idea because I got a 1 in 4 chance it's going to be worth less now than when I need to use it. For a 5-year period, it gets better. It's about 1 out of 5 years is down. 10 years is about 1 out of 10. And once we get out of to 20 years, historically, we have not had a down period that lasts 20 years. I do have to say historically, we don't know what's going to happen in the future. But if history is any guide, money that I'm going to use 20 years from now or later, being in the equity market, not necessarily a bad idea. Money I want to use a year from now, probably I want to rethink that strategy, or at least think it through about what a downturn would mean for the use of that money. One thing that I would stress about time horizon, though, is we tend to think about it as a one-time event. Like I'll say, I'm going to retire 10 years from now. I have a 10-year investment time horizon. That's a little bit of an oversimplification. If I retire exactly 10 years from now, some of the money I have invested, I'll spend 10 years from now, but some will be 11 and 12 and 13 and so on. I actually have multiple time horizons for a goal like retirement. It's one of the reasons we're going to build usually a diversified portfolio, which we'll get to in a couple of slides. Principle 5, the power of compounding. Simply said, over long periods of time, relatively small differences in performance make a big difference. What we see here, these 3 lines, is a 6% rate of return, a 5% rate of return, and a 3% rate of return. And even though 6% is only twice as much as 3%, you can see that it's more like a 3 times increase in future value. So just as we think through those mistakes that we talked about earlier, where making emotional decisions, you might have looked at that chart and said, well, that's a 1.5% decline in returns. That's not a big deal. A 1% decline in returns due to something like emotional decision making could actually lead you to have 30% less when you look at retirement if it is 40 years out. This is a busy chart, but there's some important lessons here. So what this chart represents is each colored box is a different, what we call asset class, what we might buy as investors. So you can see this blue box is bonds. The different shade of blue is large cap growth, meaning large U.S. companies that are in the growth category. This shade of blue is REITs. Those are real estate investments, and so on. Red is international, gold is cash. And there's a couple of things that we can take from this slide. One is it is very hard to predict which asset classes will do the best. Even when we have a streak of an asset class doing well for a long period of time, you can see the run up to 08, international was doing great. And then in 08, it was down. I should be wearing my reading glasses. I think that's down 43%. So what has worked might not work the next year. But if we look at this dark gray box, this is a diversified portfolio, and it's just buying all of these investments other than cash. And what you'll see is you go right down the middle. You're never going to be able to brag at the cocktail party because you got the best returning portfolio, but you're also not down at the bottom. And this brings us back to our goals. I don't know about you, but for me, my retirement goal is not to maximize my potential wealth, meaning if everything goes great, how do I have the most possible money? My retirement goal is, how do I maximize the chance that my wife Amber and I have the assets that we need to replace our income for the period that we're going to be retired? And those are 2 very different goals. And so having something that has a more predictable return, like the diversified portfolio, never going to be the top asset class, never going to be the bottom asset class, makes it more likely that I'll actually hit my long-term goal. Now, if you're the 1 in a million people who can actually predict which asset class will be right next year, have at it. It is a very rare skill to have. For the rest of us, maybe the diversified portfolio is good enough. And it is certainly a less bumpy ride because you don't have the high highs and the lowest of the lows. So let's move on to investments matching your goals. This is another busy slide, but earlier on, I told you we were going to come back to that period from 1965 to about 1982. This is the slide that we're going to talk about this. And if you've ever heard about sustainable withdrawal rates, or maybe you've heard about the 4% rule, this is where it comes from. What this slide represents is what's the percentage chance that you would have a specific stream of income that would last at least 30 years. So if I started year one of retirement and I took 8% out of my portfolio in year one, and then I increased that by inflation each year, looking back over history, if I used a 50-50 U.S. equity, U.S. bond portfolio, about 10% of the time, I would still have money left at the end of a 30-year period. And the reason that the researchers can do this is if we think about somebody who retired in 1965, we know exactly what happened over that next 30 years. And so what the researchers did was for every rolling period after that, how many times was it successful? How many times did it fail? And the reason we talk about the 4% withdrawal rule is in 1965, if you started with 4.17%, you exactly ran out of money at the end of the 30th year. And so that's why people said historically 4% has been a safe withdrawal rate. Keep in mind, that is historically. That's looking backwards, not looking forwards. So if you're tempted to look at this and say, oh, okay, 100%. If I start with 4%, I'm invested 50-50. This does not mean that you have a 100% chance of having money left at the end of 30 years. It means that historically, for all the 30-year periods that have already ended, that did work. Hopefully that's a clear distinction. I can't make any predictions about what's going forward. But coming back to what we were talking about in 1965, where you had that long sideways market that if you're thinking about being a retiree was pretty scary. The bad news is that was the single worst year in U.S. history to retire. The good news is somebody who had a sensible investment strategy and a sensible withdrawal rate did just fine over that period. If I match the time that I need the money to last to my investment strategy, then I have a reasonable chance of success. The other thing to think about from this slide, though, is if we have that same 4% withdrawal rate that was successful historically each time at 50-50, if we go down to only 25% equities and 75% bonds, still good number historically, 87% historically. But if we went to all bonds, it was only successful 44%. And here's where, if you remember when I opened, I talked about different types of risks, volatility being how much your investments move up and down each year. The flip side of that is investments that are more volatile have a higher expected return. So high volatile investments actually have a lower inflation risk because they have a higher expected return. The chance that they outpace inflation is higher. Investments that have lower volatility, that's less risk on that side, but they have more inflation risk. And this is an illustration of that. That same person who retired in 1965, inflation actually started to go up in the late 60s, and we all know what happened in the 70s. Inflation can be dangerous to a portfolio. So one of the reasons we might want to consider a diversified portfolio is balancing those two risks. If I only think about volatility, maybe I'm taking too much inflation risk. If I only take inflation risk into account, maybe I'm taking too much volatility risk. If I balance those two out, that might be a better outcome. So, nearing the end, there's going to be 10 principles. We're on number 8. If I start with a portfolio that matches my long-term goals, my next step is, how do I make sure it stays matching my long-term goals? And so what this chart shows us is, if I started in January of 2012 with a half equity, half bond portfolio, and I just left it alone, by the end of 2021, I had 22% bonds and 78% equity. Now, don't get me wrong. I'm not saying that there aren't people that would be appropriate for, right? There are certainly people that a 78% equity portfolio and a 22% bond portfolio is appropriate. For a younger investor, that might make perfect sense. But if I determined with my financial professional that 50-50 was appropriate to my goals, and my goals have not changed, then a 78-22% portfolio probably not appropriate. And we all know what happened after 2021. What happens if I don't rebalance my portfolio is the point where it's most out of whack, because the equity markets drastically outperform the bond market. It's going to get most out of whack right before the market turns, meaning I've taken more risk than I intended to. So what rebalancing means is just periodically moving myself back to whatever asset allocation strategy I and my financial professional decided was appropriate for my long-term goals, unless my long-term goals have changed. If you're building your own portfolio, you might have to do this yourself. If you have certain types of investments, they'll automatically rebalance themselves. Generally in the 401k market, if you're buying a target date portfolio or a target risk portfolio, this is happening by itself. If not, then you might want to do that yourself. So understanding risk. I already talked about how there's multiple types of risk. One thing that we also want to think about is risk isn't necessarily a bad thing. I'm not looking to build a portfolio that has no risk. That's probably not possible when we start thinking about multiple types of risks. What I want to do is build a portfolio where the risks are appropriate for my long-term goals. So I want to be aware of the risks that I'm taking. I want to know the risks that I'm taking, and I want them to match my time horizon. When we talked about how over longer periods of time, the chance of losing money in equities is lower, same thing happens in the bond market. Really, most investments that I'm going to buy, the longer my time horizon, the less chance that I lose money. So my goals, my time horizon, my risk tolerance all come together to what's appropriate for my long-term goals. Now, that was a lot of information in a 30-minute period. And if you're thinking, okay, now I've got to worry about my goals, I've got to worry about my time horizon, I got to worry about my own psychology, I got to think about rebalancing and all that. If you have the experience and the temperament and the training to do all of that yourself, great. If not, that's where a financial professional can help you match. What are your long-term goals? What are you likely to do in reaction to an up or a down market? And let's make those two things match. And particularly on the psychology side of it, it is easier to make non-emotional decisions if you're not directly tied to it. If I'm analyzing your portfolio, I'm less emotional about that. But if you were analyzing my portfolio, you would be less emotionally invested in it than I am. A little bit of distance can help. And of course, the training that a financial professional has is also very helpful. So if I were to summarize the 10 principles that we talked about, there's good and there's bad news. What we might think of as bad news, there will always be times of volatility. There will always be times where investments lose value, particularly over short periods of time. The good news is, for some of us, that is the good news. We get to buy investments when they're at a discount. But if I'm a person who's regularly selling investments, well, that regular downturn is bad news. But then the good news happens when we think these are normal. These have happened over and over again across history. And if we look at strategies that worked in other periods of extended downturns, your success is largely under your control. If we go back to that portfolio withdrawal chart, the two biggest determinants of whether your money lasts as long as you need it, how much you take out of the portfolio, meaning your spending, and do your investments match your long-term goal? That also is under your control. So bad news, the markets will go down over short periods of time, sometimes extended periods of time. The good news, what determines our success is under our control. So with that, thanks for your time, and I'll turn it back over to John.
Thanks, Doug. As I mentioned earlier, if you have any questions about any of this that has been discussed today, please feel free to reach out to your Atlas Wealth Management advisor, and we look forward to hearing from you soon. For anyone on, please have a happy and safe holiday season, and we'll be in touch. Take care.